In this video, I'm going to explain a very simple but often quite effective candlestick pattern for spotting when trends are changing. Hello, I'm David Jones, and this is my weekly technical analysis strategy video with Trading 212. Now, last time around, we introduced the basics of candlesticks, why they're slightly different to bar charts and line charts. They've become incredibly popular in the last sort of 10 to 20 years. And I said over the next couple of weeks, we'll look at some patterns. So this is week one of looking at patterns. I'm a big fan of this candlestick pattern. What we're going to talk about is the engulfing candlestick pattern. We only need two candlesticks for this to happen. I think as it's happening, it's pretty easy to spot. So it's not just one of these patterns that looks brilliant in hindsight, but you never actually see it happening in the here and now. So I think it's a very simple thing to look out for. When it comes to trading it, there are obvious levels to place stop losses to manage risk. But before we get a bit ahead of ourselves, let's look at the basics. Let's look at the textbook approach, how this pattern is actually formed. So a very simple explanation of what an engulfing candlestick looks like. It's really easy to understand. We've got a trend first of all. So the market has been going up in this example. Let's say this is a daily chart. On this day here, the market opens here, of course, trades a bit lower. There's the low, there's the high, but closes higher than it opened. So we've got another up day in the trend. Everything looks okay. But our engulfing pattern occurs if we get a day like this. So let's just put that in there. So the market opens, trades a bit higher. There's our high for the day. But then trades lower and ends up closing below the open of the previous day. So the reason it's called an engulfing candle is pretty obvious, because this candlestick engulfs the body, so the real body of the previous day's candle. So it can suggest, in the short term at least, that maybe sentiment is shifting. You know, we've seen the market take out and close below the open of the previous day. So this, not surprisingly, at the end of an uptrend, is known as bearish engulfing. I think one way to trade it, to go short, is to sell with a stop above the high of that bearish engulfing candle, because clearly if the market is going to turn around, it shouldn't take out that high point there. If it takes out the high, the pattern's over, it's not worked. But that's bearish engulfing. So if there's a bearish pattern, a negative pattern, then it stands to reason there has to be a positive pattern as well. So the market has sold off. We have a day here where the market opens, trades a bit higher, trades lower, but closes lower than the open. So far so good. You know, the market is still weak. But then we get a day, it's basically the mirror image of what happened at the top. We have a day where the candlestick looks like this. Opens down here, trades a bit lower, trades higher, but closes higher than the previous day's open. So once again, we have this candlestick engulfing the previous day's down candle. So not surprisingly, this is known as bullish engulfing. And again, an aggressive trade here would be to be a buyer, stop loss under the low, that most recent low, because again, by definition, if the market turns and takes out that low, the pattern hasn't worked. So there's two really simple patterns. I'm doing this on daily charts. We'll have a look on some other charts in a second. But bearish engulfing at the top, bullish engulfing at the bottom can be a sign that market sentiment is starting to shift in the short term at least. So there we go. We have effectively two sides of the same coin, the bullish pattern and the bearish engulfing pattern. Okay, the setup is pretty much the same. We need a prior trend. So if we've got a bearish engulfing, we want the market to have been going up for a while at least. Then we have this big day that engulfs the previous day. For a bullish engulfing, the market sliding for a few days at least. Then we have this big day that engulfs it. But as usual, it always looks very pretty and very simple when you scribble it on a bit of paper. But in the real world, let's see how it works. So let's have a look at a couple of examples in the real world for these patterns. Here's our daily chart of gold. This is the bit I'm interested in, middle of March to the middle of April. This is 2017. So the market has moved from about $1,200 an ounce up to nearly $1,290. So that's a big old move in a little over a month. Everything looks okay. We've got higher highs, higher lows. You can see green candlesticks, the market's closing up, up, up. So this all looks very bullish. Let's just jump forward one day and see what happens next. So this, the market opens higher, pushes higher, but then closes below the body of the previous candle. Admittedly, the day before was a fairly tight range, but this is our bullish engulfing. So it goes the other way and it engulfs the previous day's candle. So an aggressive trade here would be to be a seller with a stop loss over the high. So the high is 12.95. So what we're thinking here, that sentiment in the short term at least is shifting, and there's a risk the market is going to sell off. Let's jump forward in the future and see what happened next. So it's now, just a week later. The market traded sideways for a couple of days, but then has started to push lower. So far, so good. Let's go forward a bit more. So the sell-off really accelerated after a couple of weeks and dropped back almost to where the move started. So if we were looking at the market here, beginning of May 2017, these are daily candles, don't forget, it still looks weak. The day before we hit new lows for the down move, bit of a quieter day there. Let's see what happens the next day. So in this example, the bearish engulfing pattern up here, this one has worked. Let's see what the next day looks like. So now we have the opposite of what happened at the top. So the market has pushed lower, we've had a quiet day, and then we have a day where the market opens just about where it closed the previous day, pushes a little bit lower, but closes higher than the previous day's open. So these two here, this makes up our bullish engulfing pattern. So again, the aggressive trade here would be, if we think the pattern's going to work, to be a buyer with a stop loss under the most extreme low for the move. So a stop loss below, in this example, somewhere below 12.14. Maybe a more relaxed approach to this trade is putting a stop loss back under these lows, because you'd expect that to be big support. But either way, this is our bullish engulfing. So the suggestion is maybe the weakness has gone too far, the buyers are coming back in, maybe we'll see something of a rally. Let's jump forwards again. And that is how it played out. You can see there's the pattern. 3 days, the market rallies with a really big up day, and the market continues to push higher, pushing back up to those old highs. So it's a great example, this one. It's a really good textbook example, I think, over the space of, a month or so, where we saw both of these engulfing patterns, bearish up here, bullish down here, and they both played out as the textbooks say they should. It doesn't work all the time, but I think, for the purposes of this, it's a really good example. Here's an hourly chart. This is pound US dollar, and this is from January 2018. I think on hourly charts, you're going to get more of these sort of patterns. They are going to be more unreliable because they're more frequent. And I think you don't get quite the perfect patterns. But let's just look at some examples that I think could pass as bullish engulfing. I think we've almost got one down here. You can see here, the 17th of Jan, the market sells off, and we have a day, it doesn't quite though open below the previous day's close. So not quite a textbook example there, but the market does engulf the previous day's candle in the end and push higher. Over here, it's a similar sort of thing. You can see here, 19th of Jan, around about between 8 and 9 o'clock in the morning, the market's pushing higher, and we have a candle, again, not quite engulfing the previous day's candle, but it does end up closing lower than the open. So not really a textbook example, but hopefully you get the feel, for how we can move this onto different time frames. This may be a better example down here. The market only sold off for a couple of hours, but again, we have this engulfing that engulfs the body of the previous candle, and a similar sort of setup there. So if you want to trade more aggressively and trade intraday, I think if we were taking this signal here, there's an obvious level to have our stop anyway. The previous highs from up here, around about 139.42. It's where the market struggles again. So even though it's not a perfect textbook example, I think there were logical reasons for taking that trade and a very sensible level to put our stop loss at. So that gold chart, it was almost a textbook example, both of those patterns that played out over a month or so. That was a daily candlestick chart. On the hourly chart for the pound US dollar, it got a little bit more scrappy, but that's to be expected, I think. Traditionally, these were daily patterns. As we all start looking at more and more short-term data, people try and apply the same thing to the intraday charts, and there's no reason why you can't do that, but I think we do end up with maybe a less of a textbook setup. But when it comes to managing risk and where to set stop losses, the rules are still the same. If we see the pattern, then setting our stop at the extreme of the pattern, if that gets broken, the pattern's invalid. So it can set up, I think, some interesting trades in terms of risk versus reward. Like I said at the beginning, I'm a big fan of these because they are simple to put spot. It's a very simple concept. It's just a shift in market psychology. You don't need to be looking at 20 different indicators, 10 different moving averages, and all of this sort of stuff, to have a look at trading opportunities. I think if you can boil it down to a few simple approaches, it does help give, I think, clarity to your trading, and that's one reason why I'm a fan of these engulfing patterns. Next time around, we will look at another different type of candlestick pattern, but for this week, we'll start wrapping things up there. As usual, if you have any questions or there's anything you're not sure of, just leave us a message in those comments down below. If you like the video, click on the thumbs up, and if it's the first time you've seen one of these videos, we do a whole host of stuff during a week. We do jargon busting, cryptocurrencies, more traditional currencies, all this sort of stuff. So if you click on the subscribe button there and click the notification bell thing down there, you'll get notified every time we upload a new video. But for this week, from me, David Jones and Trading 212, we'll leave it there, and I hope you have a good trading week.